Gold has been on something of a tear. It has advanced now 22 of the last 30 sessions, hitting record highs. Is there still opportunities in the gold stocks, which generally have lagged the move in bullion? Let's bring in John Zechner, chair and founder of Zechner Associates. John, thanks so much for being with me. I'm curious how you think about this sector, because you like to look for value. Is this a sector that is screening as attractive right now?
Yeah, Amber, it actually has been for a while. It reminds me a little of the energy stocks 6 months ago, where the commodity was starting to act a little bit better and the stocks really lagged for a period of time. And now this year they started playing some catch up, as you discussed with your last guest there. And the golds are very similar when you look at it. I mean, gold is 20% above the old peaks. And yet a lot of the core gold stocks are still trading well below that. Their prior peaks haven't even reached it yet. And when I look back, as into the 80s and 90s, these things used to trade at, double-digit operating cash flow multiples. Now you're looking at 3 to 4 times cash flow multiples and discounts to the net asset value. So I think there's opportunity here. I mean, you don't have to be a gold bug. You just have to look at stocks and cash generation. I mean, well, no matter what the product is, if you can produce it and make a strong profit on it and you're growing, I mean, that's value in the stock market. And I think these companies represent that right now.
Why don't we take a step back first just to understand, why is gold rallying? We think of it as an inflation hedge or a defensive hedge, but it's rallying at the same time that the markets are near record highs and you have signs of euphoria or animal spirits, whatever you want to call it.
No, I agree on that one, Amber. And on top of that, you've had a very strong U.S. dollar. I would have expected the U.S. dollar to roll over, and I probably would have expected more U.S. economic weakness this year, and neither of those has occurred. And those would usually be headwinds for gold bullion as well. I think that when you look beneath it, I think there's sort of becoming problems with fiat currencies in general. I mean, maybe that's a bit of the move in Bitcoin, and certainly a bit of the move in gold, you see. And the U.S. debt problem is starting to creep forward in everybody's mind, as being, how do you deal with this down the road? And quite honestly, you look at the solutions over time of, how do companies get out of debt crises? And with 34 trillion in debt at 140% of GDP, yeah, I think you're heading into that realm. The way they do it is you monetize the debt, which effectively is you issue enough paper currency to effectively depreciate the value of your liabilities. Currencies go down, inflation goes up, and you can make your debt go away. That's probably not the solution the U.S. is looking at right now or wants to talk about or have out there. But in reality, the market's starting to price that in a little bit. And let's face it, I mean, the Fed, the U.S. Federal Reserve, has so far monetized the debt to some degree by taking, $9 trillion onto their own balance sheet and putting money out in the economy on the other side. I mean, you've just had enough sort of U.S. exceptionalism, spending from the pandemic and fiscal spending, 6% of GDP, to offset that in the short term. But there's a lot of things that argue against these currencies down the road, and gold is, still the alternative currency or the anti-currency. Maybe it gets competition from crypto as well, but it doesn't need much of a move or in demand. And so far, the only demand we've seen, Amber, has been from the central banks. They've been the big buyers. The public has not stepped into this yet. Maybe the stocks would be a better entry point for them.
If you're so concerned about the debt, I hear your point. You go maybe to gold, but wouldn't you also expect a bit of a tantrum in the bond market? Do you see that as a risk?
I do, Amber, and that's a good point. And you've actually started to see it. The term premium in the U.S. has gone up. I mean, in order to fund these debts and attract that capital, they're going to have to pay a higher real rate of interest. And for a while now, in the past decade, they've gotten away with a half a point real interest rates. Now you're looking at probably 1.5 to 2 points. When you look at where inflation is right now and where the yield on the the 10-year bond is, I mean, you're building a bigger premium in there in order to attract the capital to fund these debts. At the same time, that your two biggest buyers, Japan and China, have stepped away. The central banks are the next biggest buyer, or the chartered banks in the U.S., commercial banks, and they've got enough problems on their own balance sheets, and they're already holding. They've got still I think over a $500 billion paper loss on their holdings of U.S. Treasury securities. So there's issues there. On the other side, if you get some economic weakness, your interest rates may trend down on a nominal basis, but I think your real rates are going to be higher. So it's a lot of balls in the air here.
Let's talk specific stocks within gold that you are looking at. There's been a lot of disappointments. Newmont is a high-profile one. Are you going in the large caps? Are you looking to take advantage of some of those disconnects? Are you trafficking smaller? What does it look like in the portfolio?
I'd say more mid-sized to smaller, Amber. I mean, in the large caps, you're right. Newmont and Barrick are really have stagnated on the growth for a number of years, and they're not that attractive. If I'm going to stick with a big cap name, I stick with Agnico. They've done some great acquisitions in the past couple of years, and they really got a lot of their assets based in North America as well. So you remove that geopolitical risk. Instead of that, in mid-size, it's a variety of players. I like Torex, play in Mexico. Ridiculously cheap. The stock's up 80%, I think, in the past year, so it has recovered a little bit, but it's still trading about 3 times operating cash flow. If you can accept a little bit of geopolitical risk, maybe B2 Gold. I mean, they're under pressure because of the West Africa plays and Mali and all of that. So you obviously do have some geopolitical risk there. But quite honestly, if you want to get away from that a little bit, play one of the ETFs. The GDXJ is the junior gold stock ETFs. So I don't think any individual company is more than about 5-6% of the fund. So you're not disproportionate share of risk in any geopolitical region, and you're getting exposure to the group. When you look at it, the GDXJ, I think, traded up to $70 a share when gold was had peaked at $1,800 last time around. Now gold's at north of 2,300. I think the GDXJ is trading 41 or 42. So on a relative basis, probably looks better.
I want to ask you where gold can go. I don't often ask people because, when it's gold bugs, they'll tell me 5,000, 10,000. They've been telling me that for years. But you, as somebody, you said you're not a gold bug. I mean, where's the limit to how far you think gold can advance?
Well, that's Amber. My guess is that and a nickel getting on the bus. Well, maybe not nowadays, but anyway, that what I mean is for what it's worth, it's like how high is Bitcoin going to go? How high will oil go in the short term? As anybody's guess. More importantly, for investors, the stocks are cheap. Even if gold doesn't go higher from here, even if it drifted a little bit lower, when you're talking about 3 times operating cash flow and discounts to net asset value, those are cheap stocks. So I don't need gold to go a lot higher. Just like 6 months ago, we didn't need oil to go a lot higher. We just needed it to sort of stabilize in that region or not fall apart. And that's where you get opportunities in the stock market.